All right, folks, welcome back to the Property Couch podcast. And today's episode is a ripper, folks. We are actually going to give our mid-year property market update, folks. And not only that, we're going to have a look back to February and tell you what we told you and tell you if any of that came true. But Ben, what else do we cover?
Bryce, it's data day. We've got lots of data, and hang around to the end of the show because we're also going to give a little warning on some of the regional Queensland property challenges that might be coming. So hang around for that.
Warning, folks, regional Queensland, you got to check out that. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, Ben, in what is an episode that is about a mid-year update. How are you?
Oh, mate, it's good. I'm always loving it when we get into the data, Bryce, and we have a look at sort of what are the macro drivers driving the different markets within markets across Australia. So, yeah, I've been looking forward to this episode for a couple of weeks. I've been hitting the study books, looking at the data, and hopefully we've got a bit of a story to unpack today.
Mate, this is your happy place. You're not. You'd love to be riding shotgun with Mark McCrindle, who we had last week, and just looking at data and creating stories. So, mate, today's is definitely a happy place for you. But is life a happy place for you, mate? I mean, Collingwood can mathematically make it.
No, mate. I said it last week. Freo. I'm living vicariously through the Fremantle.
Freo not making the finals, mate. Freo.
You better win. If you win, you're in, isn't it?
No. If we're in, we're not in.
Oh,
no.
What happened?
Well, if the three teams above them,
but all you need to do is knock up GWS. What happened there?
Yeah. So no, mate. Do you know who's at fault?
Who's that?
The West Australian newspaper. They do it every time. Oh. Like the gap before. So Fremantle up by 25 points. Final quarter against Essendon. Sort of should have got it won. They were going to move into second spot. The previous week, back page flag mantle. Doesn't help, mate. Doesn't help. You're a small town. Small team, small town, and then they go and
a one newspaper town.
Get in their heads, yes.
Oh,
unbelievable. Hey,
so you don't think you'll be there?
Oh, I think it'll be very rare for us to be in, mate.
I hope you do get there. I need someone to support, right? I need someone.
I'm going to have to pick on another side, but thankfully I've got a Geelong membership. They look like they're so up top four, so probably
no, I'm not interested in Geelong winning. Yeah. I'm not interested in Essendon winning or Carlton winning. Or Essendon can't make it, so that's true. They're out. Yeah. Who else is in there? Yeah, I wouldn't mind.
Brisbane, the team that you beat last year.
Yeah, no. I've got no love for them. I went to the game on Saturday, the Twilight game. It was great.
We went on a talk about you one point.
Mate, that Nick Dacos goal through the guts that just set us up in that second quarter, and away we went.
Internet's gone crackly, mate. I can't hear you. Internet's gone crackly. Hey, folks, just so you know, for today's episode, it's for audio format, it will be fine. But we're going to talk to some charts. We're going to talk to some data. We're going to give you some rigor behind our updates. So if you have an opportunity to go and watch it on YouTube, we'd certainly encourage you to do that. And folks, whilst you're there, we'd certainly appreciate you subscribe. Help us grow that channel. Which gets our videos shown amongst more people on YouTube as well. Hey, Ben, on Tuesday night, you and I got together. We had a webinar around more. That was a bit of fun, just giving people some updates on a couple of new features, and it sort of fulfills the promise of rolling out new features at a faster pace than what we've done in the last 12 to 18 months based on getting some foundations right. But that was nice to hang out and do that, Ben.
Well, I mean, at the end of the day, we're a community for property investors, and we're building a platform for property investors. So it was really nice to be able to start to put some of those components together and really show why running your small private rental accommodation business, there really is only one good platform for that, and that's more. So if you want to go and check it out, you can do that.
And you've got to spell more a bit differently, Ben. It's moorr.com.au. So go and check that out. And we'll put a replay to that webinar in the show description too, Ben, so you can go and check that out. Hey, just a follow up summer series shout. I've been doing that for the last couple of weeks. Just want to shot across the bow for folks to start getting their mind ready. There's no prerequisite, Ben. We do not discriminate in any way. In fact,
No.
if you are someone who thinks that your story isn't worth telling, we probably think that we'd beg to differ. So if you go to thepropertycouch.com.au/my story, leave your details there. The Stig will start to reach out to you, and we'll start to curate that too, Ben. Just a little bit more on housekeeping, Ben. The Picker survey.
Yes.
It's imminent. We're about to shut the gates, and I don't know that we've begged too often on this podcast, Ben, but we're gonna probably beg at this point and say, folks, if you think that Pippa survey, I filled it out, Ben, you filled it out. We actually want to overcome the inertia that comes where people listen to the words that are coming out of our mouth right now, and they go, someone else will do that. No, please. We're begging you to be the person. It's not too late. If you're listening to this as this podcast just comes out, please go and get the Picker survey completed, because the more voices, the better the influence that you can have, Ben.
Bryce, I think it was Thomas Jefferson who once famously said, you get the politicians you deserve. In other words, if you don't vote, then you get the result that you deserve. And in this particular case, same sort of story, right? If we can't share the voice of the property investor to lobby regulators, to lobby government, and the unintended consequences that can come out of bad policy, well, if you didn't do anything about it, you get what you deserved. So that's why, putting your message out there, sharing your opinions around the sentiment and the activity over the last 12 months is really important for us to then magnify that insight and that research into talking to politicians and to talking to the regulators. So it's really important that we get a really strong number of those people who complete the survey, so we can really start to show the governments and the regulators all the challenges that property investors are facing and the unintended consequences of lower supply of rental accommodation, which means higher rents. So it really is an important survey. So please, get about filling that out if you can.
Please fill it in, folks. We want to hear from you. The bigger the number, the better it's going to be. Hey, Ben, I've just got a little proud parent moment here, but we just got an update from our head of our mortgage broking team, and gave us a summary of the amount of interest that we were able to save, because it's a program that we go through, and it's a very strong intention that we have within our investment savvy mortgage broking business to help people save interest, and obviously, in cost of pressures and all that, cost of living, pressures, all that sort of stuff. Ben, how much? 1 million? No. 2 million? No. We did 4 million.
4 million. We've done this before on the pod where we've talked about we're going to chase down $1 million and chase down a couple of million. Now we're up to saving $4 million in interest and that's the story about lazy money. And so, ultimately, even if you're not working with us, it's a reminder for you to make sure that you've got the most competitive interest rate in the market to allow you to do what you're doing. It's not the everything, ultimately buying the next property is the everything, if you're thinking of an accumulation and wealth building story. But once you're in that position, you absolutely need to make sure that you're reviewing those mortgages on a regular basis through your investment savvy broker. If you don't have one, well, you can always find out about us and use our team if you want to.
You go to empowerwealth.com.au to check that out, Ben. But it's like legally taking money out of the bank's pockets. It's kind of nice. If they would have been $4 million that gone to the bottom line for those banks, and so for the shareholders that are listening, Ben, the bank shareholders, we're sorry we took some of your dividends away, but our clients,
they're doing okay.
Our clients are very, very happy with that. So, $4 million interest saved. We've reset, Ben, and we'll keep you posted at the end of next year how we went this year in saving money for our clients, which is pretty good. Hey, my Mindset Minute theme today, Ben, I've been excited about finding different reels that I can share and show with our community. Today, I found one that I think is very much on topic for us, Ben. It's parents. Here's why you should talk about money with your kids. Let's have a little listen now.
This is why money gets never talked about in the home. There's too much pride of parenting where they think, if I don't know the skill perfectly, then I don't even want to think about it or talk about it with my kids, especially money stuff. It's because parents don't feel confident themselves with money. So then they never talk about it with their kids, and their kids learn all these negative behaviors around money from the world. We have to get more confident as parents to talk about things and do things with our kids that we might not know fully. That's okay. We can learn together and grow as a family.
All right, Ben. So I love that, and I've
yeah.
marinated on that a fair bit since I saw it, because not only with money, because that's what we want people to start talking about money over the kitchen table, which I do with my kids. I talk to them about that a lot, but it's just the whole ideology of you don't have to actually know it all for you to grow together as a family. I like this line that he said. There's too much pride of parenting where they think, if I don't know this skill perfectly, then I don't want to even think about it or talk about it with my kids. Let that land. But then the last thing he says is, that's okay. We can learn together and grow as a family. So, Ben, I thought it was particularly poignant for us here. We want people to talk about money with their families. And if you don't know how to do it all, it doesn't matter. Let's just start. Let's just do it together. Let's have conversations. And the attention and the intention that you have with your kids will make you sharper, and it'll give you a goal to actually get out of the inertia. So it just supported our mission, Ben.
Yeah, it's really good. I love it.
Yeah, so super good. All right, today's let's crack on, Ben. Mid-year property update. It's August. Yep, we understand it's not exactly mid-year, but there was a few things that we wanted to keep an eye on the data. But to kick this off, Ben, it's worth sort of noting where we are in terms of growth for the year. We're just going to do a quick round out. So year to date, across Sydney, Melbourne, Brisbane, Adelaide and Perth, and then the combined capitals. Yes, I know we haven't covered everyone, Ben. It's just a little teaser, because we will cover everyone in the episode today. But the year to date change for Sydney, year to date meaning obviously calendar date, Ben, 3.2% growth. Melbourne 1.1% negative. Brisbane 9.4% growth. Adelaide 9.8% growth. Perth is 15.6%, and then the overall combined capitals for those five capitals is 4.7%. And then if we stretch our eyes a little bit further and have a 12-month time frame rather than the 8 months that is year to date, Sydney is 5.5% up, Melbourne is 0.3% down, and then Brisbane 15.8% up, Adelaide 15.8% up, Perth 24.8% up, and overall for those five, it's 8%. So that's kind of setting the scene for today, Ben, because we're going to deep dive into a couple of things. We're going to look in the rear vision mirror and say, this is what we said in Feb. We're actually going to tell you the stuff that we think we nailed. We're actually going to tell you the stuff we think we didn't nail. But then we're obviously going to have a bit of a forward look as well, aren't we?
Yeah, we are. So ultimately, let's do some scene setting here. So even though technically it's not the middle of the year, that being June and into July, the property market really doesn't start kicking off until sort of that February, March. So we are trying to do sort of what we would consider that midpoint review as we lead into the spring season. And so because there's a lot of things that change in spring, which we'll unpack for you in a moment. But the original assumptions that we made in February, it's just so everyone understands, because we want to go back and basically check in on the predictions that we made based on the assumptions that we used. So we had the base case scenario that inflation returning to the top of the RBA's target range by the end of 2024. So basically a print with a 3 in front of it, so 3% to get in that sort of 2 to 3% RBA range, and then by down to 2.5% by mid-2025. And inside that, we said, well, we made the assumption that there's possibly 2, maybe even 3 rate cuts starting as early as sort of August, September, and then basically getting back into play. Now, we also said that the labour market, the unemployment would move to 4.3 to 4.5%. So that's the indication the economy is really slowing down. And that was the reason for triggering those rate cuts. We also made the assumption that consumer spending would continue to fall in the first half of the year and then pick up later in the end of 2024. And we said that there wouldn't necessarily be a recession as part of that, and that soft landing execution might have played out. Now, we did have obviously some derailers for that base case, and they were that domestic government and political interference in the form of more spending, keeping inflation higher. And that's what, unfortunately, we did see. So when we saw the federal budget and also a lot of state budgets, they were quite stimulative in terms of the fiscal settings that they put out there to obviously address the housing crisis and the cost of living crisis that we're currently experiencing. So the government has pushed more money into the system, namely in obviously rebates and electricity prices and those types of things, because obviously they're expanding quite rapidly at the moment. We've also got a lot of other fixed costs, such as insurances and those types of costs coming through. So that hasn't helped in terms of that story. We've also seen unemployment remain pretty strong, actually. We thought that would deteriorate a little bit quicker than it currently has. And that has meant that consumer spending and those levels have also been maintained relatively sort of softer growth, but still growing. And that's also on the back of the higher population base that we've currently got as well. We did say also in terms of supply shocks, if there was any of those geopolitical supply shocks with obviously what's going on over in the Middle East and also with Ukraine and Russia, that hasn't necessarily been the case, but it has played around with oil prices a fair bit. And that's obviously fed into obviously our higher energy costs and our higher fuel costs at the Bowser as well. So those types of things didn't play well for us in terms of getting to the situation that we're in. So recapping what we said, what did we get right? In terms of we still are debating of whether we've found that, that balance right of that soft landing. So that still remains a bit of a question mark. We've got also a wait and see in regards to where our unemployment rate gets to. We're currently sort of moving into that sort of mid-4 range. So that's on track to get to where we are. What we did get wrong is obviously the interest rate movements. So we haven't seen those in terms of the lower interest rates. And we're probably going to see those happen into the new year, which we'll talk to a little bit more. What we have also got right was we said that rents will continue to keep rising. That was obviously an easy bet with the level of the supply of rental accommodation drying up even further. And in terms of property prices continuing to go higher, we also got that story right in terms of in most markets, we've seen the property market move. But we did declare that we were going to see markets within markets, and we predicted obviously Perth being very strong, Adelaide, Southeast Queensland, Brisbane being very, very strong, and we said obviously Melbourne and Hobart were going to have their challenges, and we had a little bit of a smoky in there for Darwin as well, which has been sort of flat, and we'll sort of tell that story as well. So we've got a few things right there, but certainly the interest rate story is the one that's triggering that pent-up demand, but people are still getting on with their lives, and certainly that's off the back of that sort of really tight supply. So let's now have a look at what our base case is for the assumptions and the predictions that we're going to talk about and finish off with in today's show. So the first part of that is that inflation is not returning to the top of the RBA range by the end of 2024. Now, we will see some artificial manipulation of that data, and that's coming into obviously what the federal government has done on the electricity prices. So that is going to have a positive impact in regards to affecting the overall inflation read in the September quarter. But remember, that's a manufactured result. It's not necessarily a sustainable result. So it's the core inflation, which excludes those volatile items that we're just talking about then, is what the RBA is looking at in terms of that. So we're now predicting no rate cuts until early 2025. We think that the labour market will continue to deteriorate on the back of no interest rate movements for the remainder of this year. That's our position. So we don't see another rate rise coming in terms of our assumption. We're still saying no recession in 2024, and that's really off the back of the government spending story. So it's that stimulus that they're putting in, it's the infrastructure programs that they've got running, it's the increased cost they're putting into health and also education and those areas, and aged care that's really stimulating a lot of this current growth. So we might avoid that sort of technical recession of 2 negative quarters of GDP. What could be a derailer from our baseline case? Well, in terms of on the downside risk, there's maybe one more rate movement increase of another 25 basis points in the second half of this year. And then, or it could be the other way around, where we're seeing, banks like CBA and so forth potentially predicting one rate cut, which could also move sentiment in the other direction as well. So it's an interesting time. We think it's probably going to be a little more of business as usual, but that's not necessarily always the case when we talk about the property story. So, Bryce, let's sort of start to unpack that property story. And obviously the first part of that story is, this interest rate story here that we're looking at. We can see the rapid change in interest rates, which would normally predict a correction in values. And early on it did do that, but as the market stabilised and unemployment has remained low, so strong employment has meant that people are just getting on with their lives and ultimately continuing to buy properties and those types of things. So, with that sort of positioning of taking that money out of the, we talk about the, that water wheel, and you think about the amount of water that water wheel can collect every time it goes around. Well, when you take liquidity or when you take cash out of that market, there's obviously less water that can be collected as part of that particular story. So that's really what's driving that off the back of that inflation story. But like we always do, we want to have a look at the supply side story first, and then we'll come in and we'll have a look at the demand side story second. And so how we're going to do this is we're going to have a look at a couple of different elements here. The first thing we want to share is a couple of charts just sort of giving you the macro across Australia. So what we're looking at here is the new listings, at the national dwelling level. So what we're seeing here is a comparison of the 5-year average versus 24 and 23. Now, the good news story here is on a macro level, we're above that 5-year average in terms of the number of new listings coming into the market. So that's quite healthy. But then we actually have a look at total listings, which is really what we need to assess in terms of from an overall supply side. Is you can still see that over the 5-year average, we're actually still quite low in terms of that. So compared to the 5-year average, we're still 15.9% down, aren't we, Bryce?
Yeah, and I guess that's really the story for why most markets have performed well from the majority at the beginning of the year. We'll talk about a couple of the exceptions shortly, but the sense that if you've got 3 oranges and 5 people want to buy it, Ben, that's always going to put at the very base price pressure floors, but 5 people want to buy oranges and only 2 oranges to buy means it usually puts a bit of upward price, and that's what you'll see across some of the markets, and that's the important part. And to some of the other markets that are doing well too, as we'll unpack them, that is also the reason why you have some optimism why going forward that resilience will stay in those markets, because again, there's no sort of big U-turn on that trend as well. But there is an exception to that, and we will get to that shortly. But some of the bigger markets are actually on the flip of what I just said.
So we've now just jumped into our research platform, and we want to do a little bit of a deep dive into telling that particular story. So this is this stock on market story, and we can see that over time, what we are looking at here is the percentages of the overall stock. So that's why it only goes up to 2.5%. But let's sort of tell a bit of a story here, because again, this is that sort of 2-story market. So we know Adelaide, Brisbane, and also Perth. Look at the trend line there in terms of, we can really start to see that in terms of the availability of stock and supply is quite low and continuing to fall as part of those particular stories. And so that has bode well for underlying demand exceeding supply, and that's obviously putting pressure on house prices in those particular areas. Now, if we look at our 2 big capitals side by side, and remember just that the volume, that the actual volume of stock is enormous compared to those other cities. You're talking about 6 million people, 6+ million people in those 2 capitals. So you can see here that 1% movements are significant in terms of the actual numbers in behind them compared to some of the smaller cities like Hobart, where you've got a smaller a volume that you're dealing with here. So you can see they've been relatively steady. Okay, so there hasn't been any sort of trend line us ticking up and tipping down. And one could argue that's been what's probably supported Melbourne in a sense, in terms of why we haven't seen a further price correction in that market, because the market's sort of in balance in a way. It's sort of finding its way through that particular story. Now, then if we go to sort of markets like Hobart, Darwin, and also Canberra, we can see that the actual trend lines are actually on the up. So it means that, the absorption rate of what's coming into the market is actually going in the opposite direction. So they're not absorbing the supply that's available for sale in those particular markets. And that's why we have seen those markets performing in a negative or flat sense over the course of the last couple of, over the course of really the last part of the first half of 2024. Now, you can see that there is some trend lines. So Darwin is starting to show some trend lines down, and we'll start to see that a little bit more in some of the data coming through as well. That's sort of why in that sort of January period, I said that's a real smoky play out there. And we'll talk more about why that's a bit of a smoky play in terms of what's going to happen in that market over the next couple of years. But you can see effectively that's what we're looking at. So then when we get back into, the sort of data that we wanted to talk to, let's take a look at this chart in terms of what it actually means. And so as we sort of look at a snapshot, so we've got a couple of great snapshots here from our good friends at CoreLogic, and you can see what we were talking before about. So when you started to think about what was happening in the Sydney and Melbourne markets during that sort of end of the selling season in December of last year, you could see that you've got new supply in New South Wales or Sydney and Melbourne up 10.9% and 19.3% respectively. The overall Sydney supply was 1.5% higher at that time. And then in Melbourne, you can see that the overall supply was 9.6% higher. Now, and again, you're talking about 30,000 properties and 21,000 properties for 30,000 for Melbourne, 21,000 for Sydney. And, that's the context I was telling you about.
Yeah,
in
compared
Hobart,
to 1,500 in Hobart, for example.
yeah. And Darwin, it's 980.
Yeah.
So you can see that dispersion or significant variation between those sort of actual count number compared to the size. Now, what's leading that sort of story here about Melbourne's challenges from a price point of view is we can see that looking at the total listings, that's now 11.8% higher than what it was, compared to a 9.6 back in December. And that's a reading of, the 18th of August. And so, but we can see that there has been, Sydney is still quite a tight market. It hasn't seen any additional supply come on. And then we can also see here, the story of Adelaide and also Perth. And now, Darwin has also got that strong story of sort of a reducing supply off very low numbers, but still a reducing supply. And the one that has turned the corner also is Canberra. So we can start to see Canberra from having an overall 13.4% increase in supply over the 12 months trailing. It's now down 13.2% in terms of overall supply. So you can say that the Canberra's had an absorption story that's working itself out, and it's now becoming more of a seller's market than probably what it was as a buyer's market over that time. Now, there's a couple of interesting points here, and I want to credit Eliza Owen with some of this data as well. And that is that as of the week ending the 18th of August, we did see that new listings are tracking 2.5% higher nationally than 12 months ago. So there is a slightly higher number of listings coming through. And the other important point is that that's still 11.8% above the previous 5-year long-term average. So that does tell us that there's a little bit more supply in market, and that puts downward pressure on prices in the short term. But finally, another nice bit of data, and this is why we're doing this mid-year update, is because through the research that Eliza has done over the past decade, what usually happens is spring is the selling season, as we've all been told. So how much new supply does come on? Well, Eliza Owen's research in the past decade has shown that 18.2% increase in new listings over this period. So we've got that 2.5% out now. So how quickly is that going to come? Now, and how much of this new stock is going to be absorbed? Like, in other words, how much buyer demand is still in the market compared to the new stock coming on? Now, in a lot of cases, there may be, because there's no other stock to buy that households are looking for to upgrade or downgrade or whatever, they don't then list their property, right? The market, especially in some of our bigger cities like Sydney and Melbourne, which are balanced or in Melbourne's case, slightly negative, you don't know whether people will just basically sit on their hands and they'll have that risk aversion, that loss aversion, that, sort of that human behaviouristic sort of story that we've talked about before. So that's an interesting story in terms of how that might play out. So that's the scene setter
to really absorb that too, Ben, because supply is the enemy of growth, right? So if you can actually see a lot of I guess cause and effect here when you've got that much additional supply coming on, and then you go on to the opening read that we had around where the around the grounds was looking. Those with listings less have had upward pressure up, and those with listings more have had downward pressure. So it's a very, very important metric, and it's a very important concept at the bigger level, because I know a lot of our listeners want to try and understand this from a big picture level as well, which is
Yeah.
why we spend a lot of time going supply first, then we'll unpack demand. But we're going to talk through the regions here as well.
Yeah, I think a quick little summation of the regions we can also see, in terms of new listings and total listings. So you've got New South Wales sort of flat. You've got rest of Victoria with 16.9% total new listings. So that's going to put downward pressure on value in the short term. Then you've got rest of Queensland, which is negative 13.8. So that's where we're starting to hear the murmurs in the property sector, and all of it. In our trade, that's the trade that we live in. People are starting to talking up the regional areas of Queensland as being good buys. We've got a bit of a warning at the end of the show around that one. In terms of rest of South Australia, negative 10.6. Rest of WA, negative 23.2. Rest of Tassie is positive at 8.2. So that's downward pressure on prices. And Northern Territory is negative 9.2. So that's going to put upward pressure in terms of, because low stock means, obviously there's a risk of, or an upside in terms of future price growth that you were just talking to, Bryce. So that's the story around, obviously, the first piece of the puzzle, which is the number of stock available.
Well, existing, Ben, isn't it? It's breaking it up. We're going, what's the existing market doing before you look at what's the new supply that's coming on?
Yeah, and a great point. Nice little segue. So when we start to then talk about building approvals, and we start to look at nationally where we sit, so we do have an undersupply right now, and the story is actually getting worse rather than getting better. So this is why there's a lot of experts in this field, from Housing Industry Association and all of the sort of the peak industry bodies are basically telling the government that we've got a massive problem here, and that problem is that even with sort of freestanding dwellings and also rental or medium and high density accommodation, you can see that the trends are quite low. So we did obviously have the home builder incentive scheme off the back of COVID that really did spike in terms of people signing up to build or renovate their homes, and that's where you see that big spike happening in terms of the houses. But the trend since really the apartment boom that we saw between sort of 2013 and 2017, and that was also inspired by a lot of international investment and international buyers buying brand new off the plan units in our two big capital cities. You did see that sort of boom happening through that period, but now it's really tapered off, and there's no real appetite at the moment for an investor to be thinking about buying into anything from a new point of view in terms of these medium and high density unit accommodations. And that's problematic, because obviously that's also a critical renting pool for a lot of our, say, international students and those types of things coming in. So that critical undersupply looks like it's going to get worse, even though there is, if you look at the latest update coming through in those sort of June numbers, you can see there that there's been an uptick. So it's trending towards the decade average, but that's still below
the band.
Yeah, there's still a fair bit to go, and we need to add to supply. So in one sense, we've got governments who are doing the right thing by looking at zoning regulations and those types of things. But unfortunately, on the other hand, what they're doing is that they spend so much money, they've got so much debt that they're taxing, and so that having 50+% of the value of property being in taxes and charges, that ultimately doesn't bode well for incentivizing subdivisions and building and development, windfall taxes, higher land tax. All of that stuff is a disincentive in terms of having that investment coming in to add to that supply. So they've really messed up the incentive side by doing that, and definitely the reforms around higher density and sort of some of those zoning planning regulations. That's a good news story, but unfortunately, until they can convince investors and owner occupiers and developers and builders to actually invest that money to get that stock online, the situation is only going to get worse before it gets better.
If we pause and reflect there, Ben, it should give. It's one of the reasons why property investors should have enormous confidence in the short, medium, and long term for the actual asset class. Because on the back of Mark's conversation last week, which was really, really important. If you haven't heard that, go and have a listen to that, because it kind of dovetails nicely into what we're talking about here. But it just reminds you that we've got, to his point, there was an immigration influx that they've since tempered, that just is woefully out of alignment with the amount of houses that we've got available for people. So it's still if you just blanket that and go anywhere, that's a problem, because obviously Melbourne and Hobart have had a different story to Perth, Adelaide, and Brisbane. But it should just, for anyone who's got the jitters, or anyone who's you guys are always optimistic about property. Yeah, well, because of the data that we're presenting that suggests that the asset class is systemically in good shape, and the fact that there's so many people coming here without enough houses will help underpin that, as long as you get some of the micro stuff right, Ben.
Yeah, and have a look at some of these sales volumes, which is all really about that absorption that we were talking before about. So we can see that the 6-month moving average on the chart that we're looking at has gone above the 5-year average, which is really good. And we can see a really mixed result, even from a regional point of view, and also around the capital cities in January of 2024. But in July of 2024, they're all in positive territory, which means that there's sales activity. So though there has been positive volumes, the only negative there is the regional Northern Territory, which was down, but again, off very, very small numbers, remembering. So we've got positive story in terms of people's willingness to continue on life's journey and upgrading or downgrading their home, or buying their first home, or whatever that looks like, or buying their first investment property. That's all been quite positive. Even, in a difficult time where you would think, again, high interest rates, that wouldn't happen. And then obviously it's the employment story and that confidence in that employment story, which is telling that particular story in these charts here. So it's just about how much momentum can that be carried. Like, if, once everyone's done what they said they were going to do, and if it stays where it is, but supply starts coming on, that then obviously generally, sees that cycle run out of puff. And that's potentially where we're moving towards until those interest rates get looked at in terms of which might stimulate a bit more activity. So then when we start to look at new financing, we can see here in terms of our new financing data, the changes that have occurred. This is a fascinating chart. I'm still struggling to reconcile what's happening here in terms of, we can see that investor activity is quite strong. We're sort of looking at probably around that 37% range in terms of new lending for investment housing, excluding refinances. So we absolutely know that there's the next generation of younger investors are coming in, and that's a great news story. And they're obviously playing in the affordability belt, as are the existing investors, because of APRA's throttling of borrowing power. So we're pushing a lot of people, we've talked about this before, into that affordability area. And that's why those regional centres and also the more affordable capital cities have gone very, very well in regards to their short-term growth story, because it's just so much cheaper to get into those markets. And I can only borrow what APRA will let me borrow. So ultimately, from that point of view, that's driving. And, the trade-off and unfortunate story there is it just makes it harder for first home buyers, because you're putting all that underlying demand into that particular market. But it is also challenging in the sense that with conditions the way that they are, where is all that investment dollars going? Like, obviously we know that higher prices means we borrow more, but it's the count of the number of investment loans that I'm putting question marks on, because when I look at the ATO data, the number of new investors that are coming into market is actually slowing quite considerably compared to where it was. It's like 2/3, it's 66% down on a 5-year rolling average. So from that point of view, it's like, okay, well, are existing investors buying more properties? That's not showing up in the data either. So it could be a couple of things that I still need to investigate. And one is that, the number of loan splits that happen from a investment savvy broker, usually you would have 2 loan splits against a new investment property. You'd have equity release from another property so you don't cross securitize. And then you'd have your new loan at 80% against that particular property. So maybe that's a sign of more education and sophistication in the way in which brokers are now setting up their customers with the right lending strategy and structure, and that could be artificially inflating those numbers. But it is an interesting story. Quickly moving along, we can see here in terms of what we get in this particular data, we can see where the activity is, and this again is meant to report the activity based on where the purchasing is happening. I've always been, question mark on that data in terms of its source and reliability, but it clearly shows that there's an appetite for buying in New South Wales at the moment, which could be regional story. Victoria's flat, Queensland's up, Tassie's flat, WA is definitely up, and South Australia's up. So it's consistent with, where that underlying demand is pushing on that shortage of supply and moving values higher over the short term.
Before you run away from that too, Ben, I think
sure.
the 42.9 in New South Wales, that is the hard one to digest in that. To your point earlier about does that include splits on loans? Because I was only talking to a prominent real estate agent in Sydney maybe 4 weeks ago in Sydney's northern beaches, right? And he just said to me, look, his loan book, his property management
rent roll,
is shrinking largely because the cost to invest in his region is almost prohibitive for a lot of people, right? At that 7-figure entry level, yields being so low. And, even the conversation was around, C-suite or business owners who have got really strong incomes. Even they're finding it tough to hold on for those for the long term. So clearly, that might be part of Newcastle or Orange or Wollongong or, all the way through to the borders. But that definitely, those finance investors make sense in the markets that are flying. But, that New South Wales one would love to see under the bonnet a bit more.
Yeah, and I think that's also a good segue into looking at the rental story, right? So we've looked at buying and holding, and now we're going to look at the cash flow that's coming off those properties. So we want to take a deeper dive into that. So we've gone over into our research platform, our proprietary research platform, and let's take a look at some of the data that we're seeing in here. So when we have a look at the vacancy rates, I'll expand this out and we can have a look, and we'll sort of unpack a bit of a story here. So we can see, where are the trends in terms of vacancy rates? Well, we can have a look at sort of the strong markets at the moment. I mean, no chart tells a bigger or stronger story there about why the WA government decided not to ban no grounds evictions. Look at how tight that rental market was. And now we're starting to see, obviously a lot of investment going back in there, and that's improving the amount of supply, which ultimately means you're taking less pressure or taking the pressure off the tight rental market over there. So that is a good news story. That is sensible reform and listening to the market in terms of what you might do there. You compare that to, say, a Sydney market.
0.25 to 0.75 though, Ben, even though the trend is up.
Yeah, it's still tight.
Very tight.
Still a super tight rental market over there. And you can then, let's have a look at our biggest market in the country in terms of rental markets. We can see the same sort of thing. The trend is definitely in that sort of a cooling market, but off what we would consider chronically low results. Let's have a look at our second biggest market, and we're seeing that sort of thing there. Now, why is this? Well, you've got to remember there was one critical bit of legislation that's happened in the last 6 months from the federal government, and that is that they put a cap or effectively banned a lot of international students coming in to do different types of through their visa program. So remember, they were trying to show the public that they wanted to reduce the amount of immigration that was happening. And one of the big levers that they pulled was banning a lot of those international students doing what we might call the second tier or third tier type of courses. But that's effectively tens of thousands of additional international students that haven't come into the biggest markets, being obviously Melbourne and Sydney, in terms of attracting those international students. So that has meant that the sort of pressure off the inner city areas in terms of rental apartments in the medium and high density has definitely relaxed. But we can tell you from our ground research that if you've got freestanding houses closer to the city or even freestanding houses out in the burbs, they are still very, very tightly held, and there's very, very little availability in those particular markets. So when we look at what's happening with the yield story and the easing of rents, a lot of that has to do with these tens of thousands of students that were anticipating to arrive haven't actually arrived, and that's again taken pressure off those rental accommodation markets. Quick look at Hobart, we can see that after its tight run and a lot of investors going into that market, we saw that move quite considerably in terms of rental availability as that market started to cool down. The Darwin story, let's take a couple of these out so we can see it a little bit clearer. We can see here in terms of Darwin, that's moving into an extremely tight rental market, down sort of in the levels of WA or Perth. Canberra's sort of again, holding there around the 1%, so still pretty tight. Always remember we're anti-Canberra based on the government's regulations and also their land tax. Effectively, you might get a higher rent, but you're just giving it to the government. In terms of Brisbane, you can see there a little bit of an improvement in terms of what's coming up in terms of the Brisbane market from a vacancy point of view, and then also Adelaide also moving up. But when you look at those top performing markets, they are from the longer term trend lines down into areas that we wouldn't commonly see. And if you think about a balanced market probably being between 2.5%, not 3% like was claimed in the old days, that's telling us that there is obviously an incredible amount of rental challenges and vacancy challenges out there. And then when we start to look at how that correlates to basically the typical rental yields that we're getting, so we start to look at that rental yield story. We can see here, let's take a few of these out and unpack them. Again, we can see, starting with Sydney, we've got rental yields sitting just above 3%. You then get into Perth. So as that new supply comes in, that's going to take rental yields from a very, very healthy 5% down slightly. You've got Melbourne rental yields improving on the back of a couple of things there as well. You've got obviously slightly falling property prices, which artificially inflates the yield. And then you've also, in Perth's case, you've got rising prices that artificially deflates the yield that you're currently getting on your property. You're also seeing Hobart also having still a pretty strong rental yield in that particular market. Darwin has an exceptional rental yield at currently sitting at 6.29% across the board. Then you've got Canberra also sort of with a really strong rental yield there as well, sitting at 4%. And then you've got Brisbane and Adelaide sort of sitting in that sort of 4% range as well. So my view on this is pretty clear that I expect that we'll start to see places like Melbourne's rental yield starting to increase as that chronic supply continues to keep falling down. Then if we go and have a quick look at the actual rents that you do get in market, and this is the equalizer when we're talking in percentages. Percentages is great, but obviously it's the money that we get to take home. It's the dollars that we get to bank that's really important. So we'll start, unpacking a bit of that story. Let's start with obviously the typical rents that we're paying in Sydney, $757. In Perth, we're paying $649. In Melbourne, we're paying $567. In Hobart, we're paying $520. In Darwin, we're paying $597. In Canberra, we're paying high, but it's just going to the government in taxes and charges at $636. In Brisbane, we're starting to see that number. I think I'm on Brisbane. No, I've got too many charts open. Let me just free up a bit of space. Brisbane, $598. So again, it's got a little bit on Melbourne in terms of that. And then Adelaide, you can see, is also going quite healthily at $582. So again, still naturally good news story because the amount of supply has meant that we've been able to increase those rents. But that's remembering off the back of higher interest costs, higher compliance costs, higher insurance costs. So we'll continue to see those rents having upward pressure over time as part of that particular story, won't we, Bryce?
Definitely, yep.
All right, so let's now move on. So that's a pretty good indication in terms of what's happening from the supply side of the story. Let's go and now have a look at that sort of demand and what we sort of, what we mentioned in terms of those demand drivers and where we saw the risk. So in February, we said that the downside risk was APRA through throttling, the borrowing power of consumers. We also said that potentially through some of the forced sales or closures, we started to see a bit of job anxiety through some of the NAB surveys. We did say that household formation in terms of more renters coming together and living in a share home would happen. That's definitely materialising. We did see, obviously, affordability will always continue to be challenging in our more developed, bigger cities. We saw slowing migration would also, be the downside risk in terms of demand side. And then the government interference, obviously then stopping the investment and the ultimate supply. The upside story was chronic undersupply of housing that still remains in play. We saw, interest rates falling. Well, that didn't quite eventuate just yet. And inflation falling, that hasn't happened. And then real wages growing. So one of the good news stories that comes out of this is that, those real wages usually won't go backwards going forward. So as the cost of money with inflation going down later, borrowing power and also being able to afford more expensive homes will improve with that, those wage rises that we've seen as part of that story. So then we start to think about, all right, well, what's the August update on that particular thing? We still see APRA is throttling demand. We still see, the housing and rental crisis continuing and the political risk associated with that in terms of the politics. We're seeing the Greens starting to win a lot more favour from those younger voters on the back of false promises and misinformation, but ultimately it still wins votes. In terms of higher interest rates for longer, that's going to also potentially put downside risk on demand. That's on the back of those higher inflation with the government, fiscal stimuluses. We do have a slightly elevated risk of recession. We talked about definitely higher unemployment. So that idea of a softer landing becomes more potentially of maybe a harder landing that we've just got to try and navigate through. Housing affordability prices are still going up, so that continues to be a thing.
Ben, on unemployment, it's one of those interesting ones, isn't it? Because for the person who gets unemployed, it's a downside risk, but for the market in general, it's actually a positive sign that inflation, because that's one of the markers for inflation, right? So It's kind of like, it's great if you're not unemployed, but if you're the person who gets unemployed, it's not good for you. So it's kind of one of those double-edged swords.
Yeah, it's the blunt instrument that is monetary policy that manufactures a slowdown in the economy, which forces unemployment. Mm-hmm. And remembering inflation is driven by variables such as input costs, but also productivity of workers. And so in some cases, if the business makes a decision in terms of whether they want to maintain their profitability or basically pass their costs on to consumers to maintain that profitability, or the consumer then doesn't spend, and then ultimately the business is forced to look at their cost base, and a lot of that is obviously wages. So that's when they start laying people off as part of that story if they can't find other savings in the supply chain. So that's effectively what's happening in a slowing economy that we're seeing here as well. We've seen some increases in some forced closures or mortgagee and possession sales, but again, such a small number. It's really, I commend those people who have mortgages at the moment. They're doing a great job of staying viable. There has been, an increase in defaults, but it's coming off very, very low basis. So there's no real systemic risk there, but it still remains a risk. Student visa program we just talked about in the short term, those that rental demand will dry up a little bit in some of those isolated pockets that we were talking about. Now, in terms of the upside story, and this is the good news story here, is we've talked about it before, chronic undersupply of housing, that's going to continue to be the case. The government mixed policies around going after that planning regulation we talked about, but ultimately also potentially doing stupid things about regulating markets and not letting them to regulate themselves. And that obviously then deters people from taking action because they can't trust the government. So they don't want to spend their tens of billions of dollars on investing if they can't trust governments. Then you've got obviously the general folks who are just getting on with things. So we've seen that in terms of the actual overall activity of sales. We saw that earlier. And that is a classic case. Remember, investors should only really be 30% of the market, 35% maybe in those sort of headier times. But ultimately, we should be price takers, not price makers. So if we're the ones who are making the prices, then ultimately is that a sustainable revaluation of that asset over time? So that's the weighing machine versus the voting machine story in terms of if too many investors go into some of those affordable markets and it's just an investment story like we do when we go into regional towns and those types of things, that's where the risk lives in terms of some of those mining towns as well. So we don't want to get ahead of ourselves from an investment point of view. We want to be sensible about the long-term prospects and the fundamentals economically and also viability of those big engine rooms and those economies wherever we're buying, whether that's regional or also in the big city areas. Inflation will remain higher, so that's going to be slower to come down, which means interest rates are going to be slower. But once they do come down, boom, we will see a sentiment shift as part of that. We talked about those real wages continuing to grow off the back of that as well. So that's the precursor in terms of where we're sitting ourselves from a buy-demand point of view. So we'll take a bit of a look in terms of what that story looks like. And I'll just switch over to our research platform again. And we can see here, when we go and have a look at our demand-supply DSR ratio, we can start to see in terms of what's happening across all of those towns and cities. So when we start to look at, some of the bigger cities, so we'll start with the Melbourne and Sydney story, we can see that, interestingly enough, and this is what we're sort of saying about why Melbourne's probably been more resilient than we've expected it to be, is because there's still underlying demand there that's ultimately looking to meet that supply that's in play. And so that's been a really positive for them. You can see also Perth's story over that longer term, why we've seen such incredible 24% or whatever it was growth that we saw in those numbers we spoke about earlier. That's really come along, and so that's still very much a strong market. Then we've got Hobart. Well, again, that's why we were concerned about that particular market in terms of its price correction. So that price correction will continue over time. We've got Darwin also sitting down there in terms of not a lot of confidence and sentiment. So that's not necessarily showing any signs at the moment. People will, again, eventually stumble on that and have a look at that as a market for cash flow in the future. When we start to think about Canberra, we can see here that it's also got a reasonable level of demand and supply, and we think that's coming into a new up cycle for that particular market, but that's owner-occupied led. That shouldn't be investor-led. In terms of Brisbane, we can also see still a really strong reading in that sort of around that 60% mark is always pretty healthy. And then we've got Adelaide with the strongest reading of all at 62. So continuing to find a way to keep moving that value in terms of that overall story. So
it's
that's
worth reminding context there too that the demand-supply ratio is a secret herbs and spices algorithm.
Yes, 17 variables that make up the score out of 100.
That we created in terms of where demand exceeds supply, right? So that's in the short term, right? Which needs to be sort of put in context of fundamental analysis about what makes property go up in the long term, but it also gives you a best chance of being in front of the wave, right? So therefore, anything that's sort of above 60 would be considered very healthy. Anything that sort of starts to get below that, you start to see where supply exceeds demand. Therefore, you're not in the same position of power to see that sort of immediate growth.
Yeah, well said, Bryce. So you couldn't put it better myself. So in terms of then looking at the days on market, which is the other important measure that we want to be looking at, we can start to see the different types of markets that we've got going on here. So let's unpack that story in terms of what it looks like. So we can see here, let's start with our biggest capital city again. So we've got, the average days on market is 38 at the moment. Now that's down from around 42 that we saw at the start of the year. If we look at Perth as the secondary market we looked at here, so the days on market is now down to 29 days. At the start of the year, we were sort of looking at 35. So the trend line is very strong for those particular markets. In Melbourne, we've seen the days on market sort of sitting at around 42 in January, and that's now still sitting at 42. So again, no sort of indication of upwards or downwards there. You can see here in terms of Hobart sitting at 46, that's now moved to 49. So the trend is going in the wrong direction there for price pressure. Then you look at Darwin. At the start of the year, we saw that market sitting at 94 days. It then peaked at 100 days, but it's now back down to 94 days. So that's starting to trend in the right direction. Then we've got Canberra. We can see here again, 49 days. That's pushed out to 51 days at the moment. And then Brisbane, again, very, very strong market, even though it's had a really lovely run for several years now. You can see days on market 37 in January. It's now down to 31. And let's have a look at Adelaide. We can see also 42, and that's just come down to that 41 level. And that's why it's always important to remember when you're looking at one piece of data in isolation, you should never make a judgment just on one piece of data. It's about bringing all of that story together. And that's obviously what the demand supply score does, right? In terms of sort of putting all of that data together. That's why we use it as one of our core metrics. And we get that down effectively to the suburb level, not just looking at the macro level, because there's always markets within markets in terms of how we analyse the property market. All right, so they're the sort of two ones that I wanted to dive into. The last one I wanted to then just sort of show is the vendor discounts. So this is a nice little slide here that we can spend a bit of time in talking about. And really the thing that we wanted to focus in on, Bryce, isn't it, is we just wanted to focus in on the change between July, which is the grey, versus the orange from July 23 to July 24. And again, this is that trend indicator in terms of which way they're moving, isn't it?
Yeah, and it's in terms of context, right? The more that someone needs to discount, the more likely it sort of suggests that market is coming off, versus when the discounting is less, it means press hard 4 copies, let's go. Like, as soon as something comes on the market, it moves really quickly. So as you have a look at these numbers, you'll get a bit of a sense that sort of reinforces the markets that are moving quite strongly. So if you have a look at sort of Adelaide, Perth, and Brisbane, you'll see the vendor discounting is coming off, which reflects the speed of those
The
markets.
tighter markets, yeah.
Go to some of the regionals, and then you'll start to see the reverse happening there. So it's a really, and as you said before, it is part of our secret sauce that we put into the DSR, and then get the right weighting, because in isolation, it can't be relied upon, but in combination with other factors, it's a very important part of the piece.
And it just further cements that story and validates your position around, how the framework we use in the book, and what we talked about. Pick your big market, and then pick your local government area and why, and then you pick your suburb, and then you come down into your street assessment, and you do all that famous framework that we've sort of always been talking about in terms of how that comes together. So that's a timely reminder for that. Let's also just quickly take a moment to talk about consumer sentiment. I've been talking about this a lot in terms of the economic and RBA updates that we do. So there's a couple of things that always surprise me. So the time to buy a dwelling, and just for context, so how this is measured is 100 is a flat reading. Anything below 100 is pessimistic. Anything above 100 is optimistic. Okay, so that's the sentiment that the Westpac and AMI guys, Melbourne Institute, are trying to assess. So you can see the broader consumer sentiment across the top at a reading at 85 in August is an improvement on the month before. So that's good, because interest rates didn't go up. And that's usually what's driving the short-term thinking from a consumer's point of view. But then we start getting into the sub-sectors, and this is where the time to buy a dwelling. Now, if you look at the long-term average, that's 120.5. So the dream of wanting to own a home in this country is still alive and well. Okay, that great Australian dream. But currently, is it a good time to buy a property? That is worsening. And that's now at a reading of 71.5, down 5.8 points, and down 1 whole point over the year. Now, what's that telling us? It's basically telling us that although we do over the long term want to buy property, now's not the right time, off the back of the cost of living crises and everything else that we're dealing with at the moment. So be mindful of that. But here is the flip side of that story. What we also know from the research is that house price expectation index. So the house price expectation index long-term average is 126.5. So that's basically saying when you sample 1,000 people across Australia, most people expect property prices to continue to keep going up. That's what it's telling you. They're always thinking that it's going to keep going up. Now, why in the current reading is it sitting at 157.8? Now it's down slightly, but it's basically
month, but it's up.
It's
up from the previous year.
It's an extraordinary number, but it's basically saying, look, at the end of the day, when CoreLogic and when the media get behind those stories and everyone thinks that property prices are going up nationally, because they are, all right, that's the overall national dwelling price that we report on every month is going up. So when people think like that, they say, well, so they've got this sort of sunk cost bias around this, sort of, and effectively this short-term memory bias that sort of says, well, property prices are going up, so it's always a good time to buy a property. So we think that property prices are going to keep going higher and higher. So that is a fascinating insight in terms of, and that again drives sentiment, obviously ultimately drives actions. And so that's why we have seen traditionally where higher interest rates would normally mean property prices would nationally go down, there are times in the cycle where that isn't always the case. And if rates stay higher for longer, people just get on with their lives. And that's also potentially supported by the unemployment expectation index, which again, right now, people are feeling really positive about their job security. And that bodes well into making those life decisions of, okay, the house is now too small for us, so we're going to upgrade, or we're going to downgrade and start traveling or doing all of those things. So getting on with life. And there would have been a bit of pent-up demand off the back of obviously the pandemic. We're getting to the tail end of that now, but that's also sort of playing out in terms of people getting on with their lives. And as building companies and residential building starts to flatten itself out a little bit more, we'll start to see people, because at the moment a lot of people are saying it's just too hard to renovate or to build. There's not enough supply and it's very expensive at the moment. So they're looking to buy the existing homes that might have been recently renovated, as opposed to going to buy a house and land package at the moment. And that's again showing up in the building approvals data that we looked at earlier as well. So that's part of that story. All right, so where are we at in terms of the cycle? I love this bit of data that we get supplied from our good friends again at CoreLogic. We can see here that when we break the markets down into their quartiles, so 20 quadrants, 25th quadrant, 50% quadrant, 70% quadrant. So that's where the price activity is happening. So we can normally say in a cycle that a usual up cycle, the part of a new cycle, is where the higher end, the 75% quartile, where the values are growing first. That basically is not a bad indicator. It's not perfectly reliable, but it's not a bad indicator that that's in a new part of a cycle, and eventually that will flow through to the rest of the market. What is skewing this data, however, and I've got to flag this again, is APRA's throttle. Their 3% buffer rates means that in a lot of cases, a lot of people are being forced into the middle or lower quartiles, especially the investors, and that's potentially putting pressure on those markets. And that's why we're also seeing strong price growth across those particular markets. But
I think that's a very important point, Ben, too, because if you have a look across this chart, and for those just listening, with the exception of Darwin and the ACT, all of that first quartile is in the positive. And it's, if you're largely systemically being forced into that particular market because of that APRA throttle that you talked about, it kind of makes sense. But in the majority of the markets, just having a quick look, that lower quartile is the strongest quartile. So it kind of makes sense where that's where the demand is.
Yeah, and I think it makes a good point. So what we've then got to say to ourselves is that meaning that the cycle is slowing down, or it's because of the macro intervention that's happening that's causing that? Because you can also see where Darwin and the ACT, if it's true to historical form and there's no market manipulation, what's happening with APRA, then you would say, as I said, it's a pretty good indicator that the ACT with their highest quartile leading and the mid quartile, that's how that ripple effect will happen. So we talk about ripple effects from the most expensive land and property locations, and then the ripple affecting in terms of affordability pushes everyone out into those other areas. And so that's starting in ACT, it's starting in Darwin in terms of that. And you can see the other side of that is the back end of the cycle, which Hobart's going through right now, which is the 1.3% down the 9. So and only the lower quartiles just got a sneaky little 0.1% growth. So you'd think that that's at the tail end of its down cycle, or there might be still something to go, but there's no green shoots in that particular market. And similar to Melbourne, there's no immediate green shoots in that particular market. I've been studying sort of some of my local area recently, and I was saying this comment to you before we started recording, Bryce, that the really, really high value properties, those status properties, they are still selling very, very well. But it's the second tier and third tier or compromised properties or tired properties that are taking longer to sell. And the seller has to meet the market on those types of properties. And so we're starting to see more of that sort of B grade and D grade type properties in the market still, and that's also affecting those values. So, and that sort of fleshes itself out as part of that cycle until we get a kicker, which is that interest rate story that we were talking before about. So, quite an interesting sort of look at that market. All right, let's move along now and sort of talk about rental demand. So we can see here in terms of, the rental demand story across the different states and territories, we can see, what's been basically happening here is a story of, annual change in rents. We can see a mixed bag there, but predominantly very, very strong results except for Hobart and Canberra. And then, that was in January. And now we see, this July story, really only regional Northern Territory has been, everyone else is showing really positive stories, again, off the back of those higher costs, but also the ability to be able to pass those rents on. because of the tight rental market that we're currently seeing as well. So you've got Perth as the best market in the country, followed closely by Adelaide and Melbourne as those two, those strongest rental growth markets. And we talked before about that student accommodation story being a real problem. Let's take a look at the overall sort of monthly change in rental dwelling. So there it is. That's telling you that story. In the last month alone, you've got Melbourne still growing at 0.3, Adelaide growing at 0.6, and Perth growing at 0.3. And then you've got Sydney coming off by 0.1, Brisbane coming up by 0.1, Hobart coming off by 0.3, and the other market of Darwin and Canberra flat. And then the regional story, some positive stories there for growth on all of the regional areas except for regional Tassie, which has come off negative 0.2 as part of that story. When we then start to look at those rental yields, quick assessment of that rental yield story. What we're seeing here in the rental yield story is that as values go, we talked about this before, as values go down, rental yields look better. As values go up, rental yields look worse. But more broadly in terms of, that's why I'm always not looking so much at rental yield percentages. I'm always looking at change of rent. And when I'm doing a rental analysis, I'm looking at are the rents going up higher based on market forces as opposed to the rental yields are going down based on price movement is always a good way of looking at that particular story. Any comments there, Bryce, before we wrap it up?
I guess there's a lot that just came out of came at our audience then. So I think it's a nice spot to just recap before we conclude, right? But we opened by saying, hey, look, there's been growth across the markets from not only the beginning of the year, but for the last 12 months to date. We talked about what our base case was for the beginning of the year, what some of the adjustments are, what we got right and what we got wrong. So we're being transparent there. And then laid some track around, okay, well, if people want to take this forward, what are the assumptions that we're going to make going forward? So we've talked about those. And then we like to bring it into, the property performance is not an opinion. It's not a theory. It's based on some evidence. So we started off by going, let's look at supply in terms of established property. And we went through the metrics there. Then we went through the supply of brand new properties and talked to that point. And then we talked about the rental supply. So that rounded out that, okay, so we need supply to be in the right places so that we can get some growth. And then we broke it down into the demand and talked about a bunch of metrics where we're seeing indicators at the coalface that give us some confidence or lack of confidence based on what we're actually seeing in the market. We talked about overall the sentiment that people have towards a bunch of things, consumer sentiment. We talk about their willingness to buy a property and also where they see the future of property is. We've obviously done around the grounds in terms of the cycles, so where the particular markets are and which those particular segments are, and then had a little deep dive into the rental demand. So hopefully that's built a bit of a base case, Ben, for us to now launch into conclusion, right? Because everyone's got an opinion about property, right? But if whenever there's facts, go to the whenever there's noise, go to the facts. So hopefully that's what we've presented today, mate. But let's rip into where we think the next sort of 6 to 12 months is going to go.
Yeah, so it is going to be a story of just how much extra supply, so new listings come on, and how much extra depth of demand is in the market. So think of it like that. And then, you can think about that macroly, but you're wasting your time. You really just want to be looking at that in terms of isolated markets, right? Because it is absolutely a story of markets within markets. Always remember the broader story there, though, is that there's a chronic undersupply that doesn't look like it's going to fix itself in the next 2 or 3 years anyway. So that bodes well for both value pressure on the upside and also an improving rental income story as part of that. Now, as each day goes past, we're feeling more confident about the risk of another rate rise is sort of diminishing, but rates staying at this sort of higher level for a little bit longer is a real story. And we do know that at some point, APRA will have to move their 3% buffer rate. So they are definitely controlling the ability for people to be able to borrow. So that ultimately can also have some medium-term upside in terms of future demand. So when you are buying, where you buy absolutely matters. And so we'll continually keep pushing the story about markets within markets. All right. And so when we talk about those markets, we think that Perth and regional WA will finish the year in very, very good shape with some further short-term price growth. We think Adelaide and some of the regional commutable areas to Adelaide from its regional areas will do reasonably well. But the message is just starting to get out there in terms of their rental reforms, and that's not going to be well liked in terms of the ability to manage and run your small business property. It's going to add to costs. So make sure you do your research around that in terms of how much control you're going to have of your rental property in South Australia for the short term. Southeast Queensland continues to see that growth. It's a general growth story around strong population going into that particular market. So that will continue to do well over the sort of medium term, as well as more people choose to live there for lifestyle reasons as well as affordability reasons. Regional Queensland. Now, Queensland is an enormous state. So I just want to give a warning, and I promised this at the start of the episode, around tropical North Queensland and those areas through climate change risk, flooding, and obviously severe weather event risks happening in those particular markets. What a lot of people don't do when they're doing their due diligence is to get a quote on what their insurance premium will be, whether it be for a standalone property or as part of a body corporate. And in Queensland, it's law that you have to have the building insurances and all of those types of things. And they are astronomical. They are ridiculous. It's so bad that the federal government is trying to put an underpinning sort of, insurance policy or underwriting those premiums that allow those premium prices to go down. But this is the warning that we were saying to you before. Yes, we're in the business of buying investment properties for the long-term capital growth and the passive rental income that comes off those properties.
Yeah.
However, if we don't get that rental income coming off those properties, then it hasn't delivered that, because we're paying higher land taxes, we're paying more government fees and charges. The council start charging higher rates for investors, all that dumb stuff that then basically disincentivizes investors from coming into that market to provide the critical amount of rental accommodation that a city or a regional town needs to continue to keep building itself up. People aren't just going to walk into a city and buy. They're not going to walk into a regional town and just buy. So the less amount of rental accommodation you have, the less chance you have of economic growth and economic sustainability. So always be mindful of that, regulators and governments, when you think about taking a quick win of an ATM through, from an investors using us as ATMs. I stumbled through that, but we got there in the end. All right, next, let's go to Sydney. Sydney's got enough activity to sort of happen there to sort of say it'll probably peter out or be flat, or it might not, in terms of my prediction, it's probably a flat market with maybe a 60-40 downside risk for a little bit of a correction by the end of the year if interest rates don't change. The no grounds eviction stuff could also be interesting in terms of buyers' confidence as they get their head around the legislation. It's still not quite out yet, so we haven't seen what would be reasonable grounds, because they're going to have to seriously consider that, because talk about a big rental market, Sydney is one of those for all of those people coming into that city and trying before they buy. Melbourne is very much a story of challenge around its economic activity, and also around the appetite around the reforms that are happening around the higher land taxes and so forth. But that's a short-term point of view. This is where I will say, for those people who invest counter-cyclical, Bryce and I are still very, very strong when we take a 10, 20, 30, 40-year view. Melbourne is a mega city, as is Sydney. They are still in the top 105 population centres in the world. They are mega cities. They find a way to continue to keep developing and growing, and that puts pressure on long-term land values and ultimately puts pressure on long-term capital growth on the upside. So if you don't have something in Melbourne in your portfolio, looking at how affordable it is, you're going to see a lot of property investment commentators talk about how Melbourne is affordable, but that is not a proud thing to be proud of. It's affordable because effectively the economy is starting to falter. And once the government infrastructure spend slows down, it's going to have to be relying on business and small businesses and all those things continuing to move the economy forward. And so that's why there is a question mark in the short term over Melbourne. But if you're playing the long game from a counter-cyclical point of view, you're going to be buying in that market with less competition, which means you've got more negotiating power in that particular market as well.
And it's not inevitable that all the properties are going to go down, Ben. It's just it's the science is in the fact that averages mean some go up, some go down. So it's not buying in massively into the narrative that there isn't opportunities that exist, and that's, I guess, where that asset selection comes. But to your point, I think it's really important that it is a big city. It's a mature city. It's driven largely by owner occupiers because it's so mature. And to your point, the stats we put up before had Sydney getting more net overseas migration, but that's unusual. Melbourne gets more than its fair share of the people that want to come to this country and live here as well. So I think, again, to your point, there is a counter-cyclical argument here, but some markets will do, some suburbs and some locations and some properties, even some suburbs might go flat, but some properties within those suburbs. So it becomes a selection game.
Yeah, the population story ultimately does drive that demand story as well. So I just put that graph up for people to study if they're watching the video recording of that. So that's true. When I don't give an update on Canberra because, again, it's just too expensive. The whole regulatory and market interference in that market gives me zero confidence that that's a market that I would want to put my money into, even though it has really strong employment because it's all government workers and they get higher incomes. You're just giving all your money over. You're giving all your rental income over to the governments in higher land taxes and fees and charges, and minimum standards are ridiculous in that town as well. So that's a big pass for me. I was mentioning before about Darwin in terms of its story really is an economic struggling story. So the economy is struggling. The politics in that state is always challenging in terms of what's happening, but the rental yields are obviously incredible. So if you're thinking about commercial versus residential in terms of the trade-offs you might get from a rental and passive income point of view, that would probably be in the mix for those people who are happy with a little bit more risk appetite in terms of looking at that particular story. When we go down here for downside risk, it's the sticky inflation story that we've always talked about over the course of the last 12 months. And that's people not changing their behaviours because conditions are pretty good. I've still got a job, so I'm going to keep spending. A higher interest rate for longer, and that's about testing that sort of depth of demand that we were just talking about. So that's some downside risk, and it's that political and regulatory interference that I keep talking about and banging on about. It does change people's attitudes and confidence and behaviours around whether they invest their money through, if they're going to continue to put higher taxes and charges on investors. So that's a really important point. And to finish off on our final word, and we did mention it a fraction ago, is that we play the long-term game. So property still remains the most attractive way in which Australians express themselves. It's still the biggest barbecue conversation. And so for those aspiring Australians and successful Australians, they show their wealth through their homes, their renovations, the shows that we watch on television. Property is a big part of our DNA. And while that remains the case, owner-occupiers will continue to drive that story, and investors should be smart enough to get on the coattails of that and enjoy that growth that comes from those people wanting to live in areas, prepared to pay to be in those particular locations and enjoy the lifestyle drivers that come with that particular story. So as investors, when we're thinking about that ultimately turns up in the land value, and that gives us the confidence that over time we're going to see continued strong economic growth of the nation, and then ultimately that will then flow down into land values, which will ultimately, result in those strong capital growth returns that we're looking for, and eventually the passive rental income of these days $2,500 a week on the back of indexation. Years ago, we always used to talk about $2,000 a week, but we are going to move that up, obviously, to accommodate for the time. So that just gives you a bit of a wrap, Bryce, in terms of how we're seeing the market, and hopefully that's informed our community for that, where they see opportunities in the second half of this year.
At least until we get to February, Ben, and we get to update it again, which will be nice. But to quote the great Jan Summers, buy the right property, correctly finance it, and hold it for the long term.
Yeah.
To quote Charlie Munger, you don't make the money in the buy, you don't make the money in the sell, you make the money in the wait. So I think that's a nice point. But look, there's opportunity there for people who are open to borderless, looking for other opportunities, and staying the course. It's a cash flow game under 10 years. It's not a balance sheet game. So I certainly like some of the points that we picked up there, and we've got a lot of clients that are taking advantage of certain parts of those markets. We've got lots of clients, Ben, who also have property in the Melbourne marketplace, and so we're continually getting them to lift their eyes and remind them that they're playing this game for a lot longer than the next sort of 12 to 18 month news cycle, which I think is important. And you and I both have property in the Victorian market that we're not planning on offloading anytime soon. In fact, not at all. So, folks, hopefully that's given you a bit to digest. Again, lots of data. If you want to share that with someone that you know who might get benefit from that, maybe send them to the YouTube channel so that they can actually play along at home and see some of the stats and the data that we talk to as well. And I guess they're constant talking points for Ben and I. Not only form our views around what the information that we provide here on the podcast, but we've also, Ben, in terms of transparency, we have an investment committee within our business. So that forms part of the discussions on where we're looking to and where we're buying and what the buyers agents are buying on the ground as well. Bit of coalface feedback for the folks as well, and hopefully that's landed as it was intended. Hey, my life hack today, Ben, is super simple. If you need to divide something fairly, we've both got kids. They got, our kids are 2 years apart on both sides, so just getting them to divide something fairly. The other day, Ben, I tried this and it worked really well. So one wanted to pour the drinks, in the glasses. So I saw this little life hack and I tried, and it works a treat. So I said, one of you can divide it, and the other one can be the person who chooses first. And it's just the most wonderful exercise in human incentives you'll ever see, Ben, because those two glasses were decamillionaire perfect. Decamillimeter perfect, sorry.
Yeah. It would be. That's yep.
Mate, you didn't need to get the spirit level out. They were rock solid level. Why? Because there was an incentive. So try that.
The frustrating thing about that is as they're pouring between it, the spillage that they lose on the
yeah, but as long as they both got equal spillage weight.
That's right. That's it.
Divide up the bag of snakes, boys. There you go. One divides, one chooses. So there you go, folks. For all the parents at home,
love it.
Let human incentive kick in. Now, at this point, I'd normally go to what's making property news, Ben, but I reckon the last hour and a half.
Well, I think we've done the property to death today, man. And for those people that have hung around for the hour and a quarter or whatever we did, thanks for hanging around, crew.
Yeah, thanks for hanging around. Hopefully. So again, folks, we're just trying to be as transparent as we can. We're not pretending that we have a crystal ball that predicts the future, but we're hopefully giving you the science behind why we've arrived at the conclusions that we've arrived at. But there might be an opportunity now in the shadows of what may be been a interest rate relief. If it's up to Matt Common, it'll be this side of Christmas. If it's for the rest of the market, it's going to be on the other side of Christmas. But mate, thanks as always for the prep and the work that you do. And you and I had the luxury of going through that before we record on this. So it was nice just to refine and get that message out to our audience. So until next week, mate.
Knowledge is empowering, Bryce, but only if you act on it.
Well said. See you next week, folks.